Hey everyone, welcome back to the channel. So in today's video, I'm going to show you exactly how to invest in stocks for beginners. We are going to cover literally everything you need to know to start investing today. It's going to be quite long, so I encourage you guys to take notes. But yeah, if you've ever wanted to know how to analyze individual companies, how to set up a stock brokerage account, and also how you can actually be profitable investing in stocks, then this is going to be the video for you. Again, completely free. I just really want to be helpful and encourage you guys to start investing as soon as possible. Let's get started. So here are the things that we are going to cover in this free course. First, we'll go over why you literally need to invest right now. We'll also talk about what exactly stocks are and how they make people money. We'll then talk about the different types of stocks you can buy, as well as the easiest way to open up a brokerage account. And I'm actually going to take you guys through a couple apps and show you how easy it is. Next, we'll talk about account types, as well as the whole concept of timing the market. We'll talk about the best way to do stock research, any key terms you need to know. We'll also talk about the two different ways that you can make money with stock investing. And then with the taxes, we'll talk about how you can deal with taxes when investing. So when you have profits, as well as when you might have losses. We'll talk about beginner tax strategies that can actually reduce your tax liability. We'll then go through value versus momentum investing. We'll talk about Warren Buffett's principles of investing that have, really served him quite well. We'll talk about how long or how short you should hold stocks, the importance of investing early, how much money you should actually start investing with. And trust me guys, you don't need a lot to invest, as well as how to do due diligence. And we'll cover all these things and a lot more, so I'm really excited for this video. So a little bit of background about myself as an investor. Currently, I am a real estate broker and serial entrepreneur. I run multiple businesses. I've been investing for over 8 years now. And in that time, I've built up a portfolio close to 7 figures. I've spent a lot of time in the investing space learning on my own. I'm also an active investing, personal finance, entrepreneurship YouTuber. And yeah, when it comes to investing, I am just a big believer in learning the fundamentals of investing. I don't day trade. Instead, I focus on the fundamentals of different companies, learning how to actually analyze them. And overall, I'm just a huge advocate of investing for anyone to build long-term generational wealth. I think everyone watching this video, if you have not yet already, should take these steps to begin investing as soon as you can. And if you watch this video until the end, you're going to have literally everything you need to know to start investing today. So let's talk about why you need to invest right now. And this really comes down to the principle of compound interest. Compound interest, you guys, can make you a ton of money. Every bit of time that you're not investing is actually going to be money lost. And if you really want to get very rich, you guys, you need to build passive income, and investing in stocks can allow you to do that. It's going to let your money work for you while you're sleeping. And so you're not always directly trading your time for money. You guys need to understand that time in the market is way more important than timing the market. And this basically means that you need to start investing as soon as possible rather than trying to, time the lows and highs of the market. Because as you'll see later on in this video, that's very, very hard to do. And the most successful investors in the world spend the longest time in the market rather than trying to guess the highs and lows. That's why it's important to start investing whenever you can, no matter what the market is doing. And if you look at the long term, investing is very safe and it's very profitable. Let's talk about inflation for a sec, because I know this is something that is on the news a lot. Depending on when you're watching this video, inflation might have changed, but right now it's around 9%. And this basically means that money is losing value over time. To build wealth, you need your money invested for it to actually grow faster than inflation. This is one of the ultimate hedges against inflation, because if your money's just sitting in the bank, it's actually losing value. Rather, you want your money in the market so that it can grow. Most savings accounts right now give you under 1% APY, so that's well below the inflation rate, meaning your money is still losing value. Real estate, businesses, and other assets can also grow faster than inflation, but this video is about stock investing. Now, right now, everything is on sale, right? All 3 major stock market indexes are down year to date. And this is actually the best time to invest, when the markets are down and people are scared of investing. This is the perfect time to build your income as well as invest as much money as you can. Historically, the average bear market within the last 140 years has experienced a decline of 37%. And the thing is that we can never predict the bottom. And historically, the average bull market lasts more than 5 years, with a 198% return. So it is very possible that we can see the S&P 500 at around 8,000 by the year 2028. If you look at this chart, it's just really going to show you why you need to start investing as early as possible. So if you start investing $5,000 annually at age 22 and compare that to investing $5,000 annually at the age of 32, so a difference of 10 years, you can see that when you retire at age 67, the person that starts at age 22 is going to have $1.063 million to be exact, compared to $557,000 for the person that started investing just 10 years later. So those 10 years actually allow us to double our money at retirement. And this is really because of exponential growth, right? You need to spend as long as you can in the market, and every additional year is going to increase your end result by a large margin. Now let's talk about what the stock market is. So basically it's a marketplace where buyers and sellers trade shares of companies. In the US, it's regulated by the Securities and Exchange Commission, also known as the SEC, and publicly traded companies are actually making shares available for anyone to buy and sell on the open stock market. They become public by doing an IPO, an initial public offering, and basically what happens is an investment bank takes on the company IPO, buying up the company's shares. So they're taking on the risk, and then they're selling those shares on the market for a fee, which normally is a percent of share price. There are 13 different exchanges in the US, for example, the New York Stock Exchange, the NASDAQ, Dow Jones, so on. And it's really cool because this whole system allows individual investors to buy and sell in a regulated environment, sort of like an auction. Now, why would companies actually want to IPO, right? It actually allows them to raise money through share offerings, and it allows investors to participate in financial achievements of major companies. So let's talk a little bit more in detail about what a stock is. Essentially, it's a piece of a company, a very, very small piece. By buying one share of a stock, you are owning a piece of the company through your share of ownership, which is a type of currency that is backed by that company. Units of stock are called shares. So if you buy one share, you own one piece. And like I mentioned, corporations sell stock to raise funds for their business. You can own one share of a company, you can own multiple shares, or you can even own fractions of shares. For example, if we take a look at Amazon, you can see that they're trading at just over $100 a share. So if you were to pay, $108 right now, you would essentially get one share of Amazon. And there are over 10 billion shares outstanding, meaning if you buy one, you're going to own 1/10 billionth of the company. You can also buy partial shares. So if you don't have $108 to invest, you can put, let's say, about $11 in. That's going to buy you 1/10 of a share. And a ton of different platforms allow you to do this, and we will be talking about that later on in this video. Now let's talk about the different types of stocks you can buy. First up is common stock, and this is what you and I will be trading. With common stock, you're getting ownership in a company and a right to vote, right? So you get one vote per share that you have. Some stocks pay out dividends, so we'll cover this more later on, but this can be variable and it's not guaranteed. Over the long run, common stock can yield higher returns than most other investments, but with those higher rewards also comes higher risk. Then you have preferred stock, right? And this carries characteristics of both bonds and stocks. You don't get any voting rights, and it does have a more stable dividend that is received before common shareholders. So in the event that, profits aren't big enough where they can pay both preferred stock owners and common stock owners, they're actually going to pay out the preferred stock owners first. And the same thing in case of bankruptcy, the preferred stock owners are going to get paid out first. Preferred stock is less volatile, so it's harder to lose or gain value. So the main difference between preferred and common stock is that preferred stock gives no voting rights to shareholders, while common stock does. Preferred shareholders have priority over a company's income, meaning they are paid dividends before common shareholders. And yeah, common stockholders are last in line when it comes to company assets, which means they'll be paid out after creditors, bondholders, and preferred shareholders. But you guys, the benefit is that you get the option to vote for a board of directors as well as company policy. Overall, just know that these two different types of stock exist, but you guys will probably be just trading common stock. And then third, you have ETFs and mutual funds. So both ETFs and mutual funds, they track and invest collections of stocks or assets. Mutual funds are a little bit more complex in structure, but they're both pretty similar, meaning that they're both tracking some type of index. Mutual funds are actively managed, so they have higher fees, and ETFs are passively managed, usually resulting in lower fees. ETFs can also be actively traded throughout the trading day, while mutual fund trades close at the end of trading day when final price is calculated. Now let's talk about categorizing stocks in terms of their size. And overall, you have small, mid, and large cap companies. Market cap or market capitalization is the total value of all the company's shares put together. And so small cap is going to be between $300 million and $2 billion of market cap. Mid cap is going to be between $2 billion and $10 billion. And then usually large cap is going to be $10 billion or larger. You can also categorize stocks in terms of sectors. So you have your tech sector stocks, you have energy stocks, auto stocks, etc. You can also categorize by location. So you have companies based in the US, Canada, China, whatever other countries. And you also have growth versus value stocks. So growth stocks can possibly outperform the market due to future potential. So these are usually going to be tech stocks like Amazon, Meta, Apple. So with growth stocks, they have the possibility of gaining a lot of value, but they are also more volatile and more risky. And when you compare that to value stocks, these are companies that are currently trading at a discount. And on a risk-adjusted basis, value stocks actually outperform growth stocks historically, but this does not necessarily mean that value stocks are exclusively better than growth stocks. So usually people like to invest in a combination of both. It really depends on your situation, your risk tolerance, as well as the time frame of the investor. Let's talk about different risk tolerances and where stocks fall into it. As you guys can see, cash is going to be the lowest risk tolerance, right? Because cash is actually just money in its most tangible form. But with inflation, you guys, I'd say that cash right now is actually a little bit more risky, because just by holding cash right now, your money is inherently just losing value. However, in the grand scheme of things, with cash, you're not putting it into something that, could go up or down. So I'd still say it is the most safe. Next are bonds, which give you small returns and are still very, very safe. After that are index funds. So if you want to invest in, let's say, the S&P 500, this is going to be a lot safer than investing in individual stocks, because with index funds, you are investing in the market as a whole. Your risk is spread out over tons and tons of different companies. Whereas, of course, with individual stocks, some companies might go out of business. You might lose all your money. So that is really why index funds are a safer bet. After individual stocks, there's real estate. So this is a little bit more risky than investing in the stock market. And even riskier than that, for me, is going to be crypto. Crypto is super, super volatile, right? We've seen some extremely big gains in the last couple of years, but we've also seen some extremely big dips in price. I'd say that the riskiest of all, though, is trading options, because you are highly leveraged when you do this, and it's very, very easy to lose all your money. I'd say that most people that try trading options are going to lose their money. So that's why I don't want to talk about options in this video. We're going to focus more on the fundamentals of investing. Here's a screenshot of the Vanguard S&P 500 ETF, VOO. A majority of my money is in this ETF, and it's an ETF that I really, really recommend you guys look into as a beginner investor. By buying this ETF, you are essentially just investing in the top 500 companies in the US. And so over the long term, you're basically just investing in the US economy. If you believe that the US economy is going to do well in the long term, then this is one of the best investments that you can make. So next, let's talk about the different types of brokerage accounts that you can open. First is the taxable account. And this is the standard account that most people think of when they think of a brokerage account. With these taxable accounts, you guys, you are paying taxes on any gains you make. So if you buy a stock at, let's say, $10, it goes up to $15 and you sell it for a $5 profit, you owe taxes on that $5. The tax rates that you're paying are going to depend on how long you hold your investment. So later on, we'll talk about short-term versus long-term gains. And in the taxable account, it's going to let you buy and sell stocks, bonds, mutual funds, ETFs, and more. Within the taxable account, there's also your cash versus margin account. So with the cash account, this is when you're buying investments with money that you yourself deposit into the account. And with the margin account, this actually lets you borrow money from your broker to buy investments. And as you guys can probably tell, that's a lot more risky. Most people are going to have multiple taxable accounts. And in just a couple of minutes, I'm going to show you guys how to set one up. Aside from taxable accounts, you also have retirement accounts. And the awesome thing about retirement accounts is that they are tax advantaged. Investments in these types of accounts are sheltered from capital gains taxes, and this is going to reduce the amount of taxes that you are paying. Basically, the government wants you to safely retire with money, so they give us these retirement accounts that are actually really, really tax advantaged. And so for for everyone that's watching this video, if you can, definitely open up a retirement account. Retirement accounts include things like the Roth IRA, the traditional IRA, the SEP, the solo 401k, and the 401k. There are contribution limits to this because, of course, they don't want you to put all your money into these tax advantaged accounts. So with Roth and traditional IRAs, you are limited to $6,000 per year or $7,000 if you're age 50 or older. There's also different rules with SEP, solo 401k, and 401k accounts, but we're not going to get into too much detail about that. And with all these retirement accounts, there are withdrawal rules. So you can't actually withdraw the money until you are retired. But if you do want to withdraw them, you can with a penalty. So that's really great because they are encouraging you to invest for the long term. There are many other accounts besides these two, right? You have your HSA, your health savings account, and this is also a tax advantaged medical savings account. You have the 529 college savings plan. This is state sponsored and it allows you to use money in this account to cover education expenses. You also have your custodial brokerage account. So if you want to invest before you're the age of 18, this is the type of account you'd want. And there are also robo-advisors. So these are automated algorithm driven investment platforms that handle all the work for you. This video can't really dive into each of these accounts super hard, but in the next slides, I'm going to show you guys how to open up a standard taxable account. Doing this is going to allow you to immediately be able to buy and sell stocks. And you guys, there are so many different platforms out there, but for beginners, I'd actually recommend using an app-based brokerage. They're super easy to set up. There's no minimum account balance, and they usually have very easy to use interfaces. So I'm gonna be putting a bunch of links down in the description below, and if you use those links, you'll actually be able to get a ton of free stocks just for signing up and funding your account. So yeah, it's free money, and I really encourage you guys to do it. In this video, I'll be taking you guys through Webull, Moomoo, as well as Wealthfront, which is a robo-advisor. And like I mentioned, all the links are gonna be down below, so you can use those to get your account with your free stocks. But basically, the application is extremely easy. It should only take a few minutes. And what you're gonna do is you're gonna enter in your personal information. So your social security number, your address, your name, your date of birth, and some other stuff. It's gonna have you set up a username and password, and it's going to have you verify your identity. After submitting this, you're gonna wait for your application to be approved. This is usually very fast. Then you're gonna fund your account with money from your bank account. And then from there on, you can start buying and selling stocks. What I encourage you guys to do is sign up on your desktop using the links down below. It's just a little bit easier, but of course you can sign up on your phone as well, and then download the app, log in from there, and start trading directly on your phone. So the first app I'm going to show you guys is Webull. This is one of my favorite apps. I've been using it for I think 2 or 3 years now. So here's my dashboard. You can see my net account value up here. If I scroll down here, I can see some of these stocks that I'm into. So let's just pick one, Oracle. Here's going to show me my market value of the stock I have. So I have about $1,200 in Oracle. The average price that I bought them for was $57.23, and the last current price is $69.50. You also have your watch list here, so this is where you can actually add any stocks that you're interested in. So let's take a look at Apple. I'll show you guys how you can sort of use Webull's tools to analyze different stocks. You can see that they have tons and tons of different data here. Here's a chart with the price. You can look at the order book, which is really cool. You can look at the order flow distribution. You can also come here to news to read different articles about Apple as a company. And they have an analysis tab here, which is really awesome. They have analyst ratings. So currently, they're saying that it's a buy. They have price targets. They give you all these different key terms as well as their values. You can look at the technical analysis. So you can see right now they have a bullish signal for Apple. And yeah, there's just a ton of different information on this app, which makes investing super, super easy. And what I recommend doing is take a look at all these different things, do your own due diligence about each company, and then make a decision about whether or not you want to invest. So let's say I do a couple hours of due diligence about Apple, and I think, hey, this is a company that I want to buy. So I'll click trade right here. I'll set my order type. So right now I'm going to set it to market. I'll set how many shares I want to buy, and then I'll click buy right here. After that, it's going to have you confirm by clicking the confirm button down here. If you want to sell, it's the same thing. You just come here to sell. You can choose how many you want to sell, and then you'll click sell and confirm that way. So next up, we have Moomoo. This is also a very great app that's great for beginners. They're also giving you guys a ton of free stocks when you use my link down below. And you can see I'm here in my dashboard. You can see this is my watch list. So these are all stocks that I'm following. If I click on any of them, it's going to take me to the page. So for example, Tesla. There's also a ton of information right here. So you can see that the current price is $714.94. We can scroll down here, look at the order book. You can see all the trends and stuff. You can also look at news up here. So very similar to Webull. You can also go to the analysis tab, and they have tons and tons of information here. So you can see the short sale analysis. You can look at the indicators. So right now it's between bearish and bullish, so no obvious signal. You can look at an analysis of the company valuation. So the current PE ratio is 97, which is quite high. You can look at institutional holdings. You can look at analyst ratings, as well as the target price. You can also look at the financials. So you can check out the revenues right here. You can look at indicators, estimates, as well as different statements. Overall, so much information here. It makes trading really, really easy, and it really does allow you to make a more informed decision about what stocks you invest in. So let's say I want to buy a share of Microsoft. So I'll click on this. You can see the current price is $254. I'll come down here to trade. Here it's gonna have me enter in my order type. So just to make things easy, I'll set a market order. I'll enter the quantity I want to buy. So let's say I want to buy 2 shares. That's going to come out to $509.84 about. And then I'm going to click buy right here. It's going to have me enter in my trading password, and then I'll click buy again. It'll have me review the order details, and from there on I can click confirm. Same thing if you want to sell, you'll set the number you want to sell. You'll click sell right here. It's going to give you the details, and then you'll click confirm. Overall, super awesome app, you guys. I really encourage you, if you are a beginner, check out Webull or Moomoo. They are, in my opinion, 2 of the best app-based stock brokerages you can get. And they just give you so much information about any stock you're looking at, so that you can really make an informed decision. Again, the links to Webull and Moomoo are gonna be down below. And when you use those links and sign up and fund your account, you will literally be getting free money. So yeah, I just really encourage you guys to take action and sign up today. So besides investing with Webull and Moomoo, I also wanted to talk about robo-advisors, which are a really great way to invest. If you guys don't know what a robo-advisor is, it's an investing platform that uses software to invest your money for you. So this is really great for people that want to invest more passively and don't have the time or energy to be constantly researching investments, checking their portfolios, and buying and selling. And the best platform for this, in my opinion, is going to be Wealthfront, which is a robo-advisor platform that's really amazing for beginners because their expert-built software invests for you, and they'll actually give you $20 to start if you use the link in the description. You only need to deposit $500 to get started in less than 5 minutes, and I will say that you do need to be 18 years old. So what are robo-advisors? Well, like I said, they help you invest your money for you through automated software that builds a personalized portfolio for you based on your risk tolerance and goals. More importantly, they're like a much more inexpensive version of a financial advisor. So they build you a diversified portfolio just for your needs, then handle the rebalancing for you and make sure you stay at your target risk level. Now, Wealthfront is good for anyone who wants to be a passive investor and just be invested for the long term. This can be more safe compared to being an active investor or trader who's always trying to time the market. Robo-advisors like Wealthfront are also good because they often require less capital to start than a human financial advisor, and the annual management fee can also be much lower. In this case, Wealthfront's is just 0.25% versus the 1% or so you might get with a human advisor. And so yeah, what I love the most about Wealthfront is they have automatic tax loss harvesting, which is when they take advantage of dips in the market to help you lower your tax bill at the end of the year. Tax loss harvesting is especially useful during periods of market volatility, and it can really add up over the long term. But you guys, doing tax loss harvesting yourself is extremely manual and time consuming, which is why many people only do it every couple of months. But with Wealthfront, they're checking for tax loss harvesting opportunities every single day, meaning you can save money on your taxes and will have more money to reinvest. So yeah, like I said, they are my favorite robo-advisor platform that I recommend for everyone to invest with, especially if you want to passively grow your money. You can invest in low-cost ETFs, you can build customized portfolios by picking from hundreds of different funds, you can even open up retirement accounts like your Roth and traditional IRAs, and they also offer college savings plans, joint accounts, 401k rollovers, and more. And like I mentioned, they only charge a 0.25% annual management fee. And if you guys want to get your $20 for opening and funding your first taxable investment account today, you guys can use my link down below. And yeah, it's just a really great and underrated way to invest. So now I'm gonna show you what the inside of Wealthfront looks like on your phone. So it's gonna show you your current net worth as well as your expected net worth if you continue investing the way you're doing when you retire. If I scroll down here, you can see these are going to be your cash accounts. These these are going to be your investment accounts as well as any liabilities that you have. And you guys can add or link new accounts. What we're going to be focusing on today is the individual investment account. So I'm going to click on that. It's going to show you the growth over time. It'll show you what your money is invested in. So we're in US stocks, foreign developed stocks, emerging market stocks, dividend growth stocks, municipal bonds, and a little bit of cash. You can always edit your portfolio whenever you want. You can use the slider and choose how much you want in each of these funds. And you can play around with it until it reaches a total of 100%. You can also add investments as you please. Let's say I want to add VTV, so the Vanguard Value ETF. I'll click on that. It'll show me all the information about it as well as the expense ratio. And then I'll click add to portfolio. From there on, I can adjust the percentage and I'll just remove that from another fund and then click continue. And then I'll click on update portfolio and it's going to automatically do all this for me. And yeah, if you want to transfer money into it, you'll click transfer money here. You can view your scheduled transfers. You can also set automated savings. So it's going to automatically deposit money into your account. If you go to the explore page, you can look at some of the portfolios that they have built out. So this is super cool. You have your classic, socially responsible, as well as direct indexing. And yeah, overall, I just really love Wealthfront. I think it's one of the best ways for you to invest, especially as a beginner, because it encourages you to invest for the long term. Their account management fee is super small, and you can set up recurring deposits, meaning you are dollar cost averaging into the market. Again, the link for Wealthfront is going to be down in the description, and you're going to get $20 for free when you set up your individual investment account and fund it with $500 or more. So now let's talk about the different types of trades that you can make. And the first one we're talking about is market order. A market order allows you to buy and sell immediately. So it is the fastest and most basic type of trade, which guarantees execution of your order, but it does not guarantee the execution price. What's going to happen is it's going to buy or sell near or at the current execution price. And that's the price that you're seeing on the screen. Now we'll say that the last trade price is not necessarily the price at which a market order is going to be executed. So let's say a stock is currently trading at about $100. So if you do a market buy, you will buy that stock for around that price, but it is not guaranteed. The larger cap the company, the more likely it's going to be able to fill at that exact price. And with these large cap companies, since trading is happening all the time, your order is going to fill instantly. Now, another very popular type of order is going to be the limit order. And this is going to allow you to buy or sell at a specific price. Basically, the order is only going to execute if the stock hits that price. So a buy limit order, for example, is only going to execute at the limit price or lower. And then a sell limit order is only going to execute at the limit price or higher. I know that sounds a little bit complicated, but let's go through an example and it's going to make a lot more sense. Let's say you want to buy a stock and it's currently trading for around $16. If you set a buy limit order of $15, it's automatically going to buy the stock if the market price hits $15 or below. So if that stock never hits $15 or lower, then your order is not going to actually execute and you won't buy the stock. Normally you'll want to set a limit order pretty close or just a little bit underneath the current market price. And that way it's very likely that the order will execute because, you know, the price does swing a little bit. But let's say the price is currently $16 and you set a limit order of, let's say, $5. That stock would have to drop to $5 in order for your order to execute. And that's very unlikely. So that's why it's guaranteeing a specific price, but it's not guaranteeing the actual buying or selling of it. Another example is, let's say you set a sell limit order of $18. This means that it's only going to sell the security if the market price hits $18 or higher. So let's say with that stock that's worth $16, if we set a sell limit order of $18, then the share price would have to go up $2 in order for us to actually sell it. If it doesn't hit that $18 market price, then we won't actually sell the stock. So the easiest order that you guys can do is going to be a market order because it guarantees that you buy the stock. Whereas if you want to get a little bit more complex, you can do a limit order to guarantee the price that you're paying. Another type of order is the stop order. And this is when you buy or sell when the price moves past a specified price. So when a stop price is reached, a stop order becomes a limit or market order. And so an example of this is a buy stop order. And this is entered at the stop price above current market price. And something like this is used to limit losses or to protect profits on a stock that you have sold short. In other words, it's a strategy that allows you to profit from an upward movement in a stock's price by placing an order in advance. So let's say a current stock is trading at $100 and you set a buy stop order at $105. If the price goes above $105, meaning we have some upward movement, that's going to trigger that buy order. And then you have your sell stop order, and this is entered at the stop price below current market price. And this is just used to limit losses or to protect profits on stocks. So let's say we have that $100 stock and you set a sell stop order at $90. This means that if the price of the stock goes below $90, it's going to automatically sell it. Now let's talk about how to research stocks, right? So these are going to be the most important metrics for you guys to understand. First is the price. This is the price you see on all of these platforms, and it's the cost to purchase one share of the company's stock. I will say that this does need context because you do need to know how many shares there are in total. Just because one share of one company is, say, $10 and one share of another company is $100 doesn't mean that the $10 stock is undervalued or a better buy. I also like to look at 52-week lows and highs. So this is going to be your minimum and maximum price of the stock within a 1-year trading period. This basically just allows you to understand the history and movement of the price of the stock. You also have your trading volume. So this is the quantity of shares traded during a given period. High volume means that a lot of people are trading it right now. And what you want to do is you want to pair it with the trend of the price. So if the price is going up and lots of people are trading, then there is upward momentum. If there's lots of trading and the price is actually going down, then that would mean that there's downward momentum. There's also market cap, which we briefly went over before. And you have your small, mid, and large cap companies. You also have the beta, which is the stock's volatility in relation to the overall market. So if the beta is under 1, this means that on average, it's less volatile. And if the beta is over 1, that means it's more volatile. And you have your PE ratio, which is the price per share divided by annual earnings per share. Or you can think of it as total earnings divided by total shares outstanding. So this allows you to see how big or small is the price of the stock compared to the company's earnings or profits. Let's talk a little bit more about the PE ratio because this is a very important term that you guys should know. And really the PE ratio allows you to compare companies based on price versus how much money the business is actually making. So let's say you have a company with $100,000 in earnings last year. The market cap of this company is also $1 million. So to calculate the PE ratio, we're going to take $1 million, so that market cap, and divide it by $100,000 in earnings. And that's going to give us a PE ratio of 10. Let's say that there's another company with earnings of $200,000 last year. Their market cap right now is $1.5 million. So to calculate the PE ratio for this company, we're going to take 1.5 million divided by 200,000. And that's going to give us a PE ratio of 7.5. So now you can see we have two different PE ratios, one for each of these companies, and it's going to allow us to compare them. The second company in this case is technically a better deal because it does have a lower PE ratio. This is probably one of the most important calculations you can do or understand. So just memorize this formula and know what it means. Next up, we have the PEG ratio, and this is your price to earnings to growth ratio. To calculate this, you're basically taking the PE ratio, so that thing that we just calculated, and divide it by the earnings per share growth over a given time period. I know this sounds a little bit complicated, but this is basically allowing you to value a stock while factoring in expected earnings growth. So it's a more standardized way of comparing companies with different growth projections. The PE ratio is not always the best indicator of a stock's true value. And in my opinion, the PEG ratio can often be a better indicator of the stock's true value. So with the PEG ratio, the lower the number, the better. If you have a PEG ratio of under 1, this could mean that the stock is undervalued, especially compared to the expected earnings growth. And if you have a PEG ratio of over 1, this means that it could be overvalued. Let's go over an example of a PEG ratio because I know it might seem a little bit confusing. So let's say we have company 1. They have a share price of $5. The earnings per share this year is $1, and the earnings per share 1 year ago was 80 cents. So first we calculate the PE ratio, which is going to be 5 divided by 1. And this gives us a PE ratio of 5. Next, we're going to calculate the earnings growth rate, and that's going to be 1 divided by 0.8. 1 is the earnings per share this year, and 0.8 is the earnings per share 1 year ago. You can do that. You're going to subtract 1 from that, and that's going to give us 25%. You're going to do 5 divided by 25, and that gives us 0.2. Now with company 2, let's say the share price is $10. The earnings per share this year is $1, and the earnings per share 1 year ago was 66 cents. So first we calculate the PE ratio. So 10 divided by 1, this gives us 10. And then the earnings growth rate is going to be 1 divided by 0.66 minus 1, and that's going to give us 0.52 or 52%. We're then going to take that P ratio of 10 and divide it by 52, and that gives us 0.19. So in this case, right, the first company actually had a lower P ratio, but when you look at the PEG ratio, since the second company has a bigger earnings growth rate, that one actually has a lower PEG ratio. So some people would actually think that is more of an attractive buy than company one. Next up is going to be dividend yield. And this is how much a company pays out in dividends each year compared to its stock price. The way that you calculate this is you're going to take the annual dividends per share and divide it by the current share price. And the dividend yield is expressed as a percentage. So while investors probably want to be paid more dividends, a higher dividend yield could mean that the business is not reinvesting its cash properly, or the business's share price is declining. And this would result in a higher dividend yield based on how it's calculated. So let's say you have a company and its share price is $100, and every year they are paying out $5 in dividends. You take 5 divided by 100. This gives you 0.05, which is 5%. So in this case, 5% is going to be your dividend yield. Essentially, they are paying out 5% of the share price every year in dividends to shareholders. Now, when companies are paying out too much dividends, this actually leaves less cash for them to reinvest in their own business. So a lot of these companies that have high dividend yields actually don't grow as fast as other companies. So that is definitely something to consider, right? A high dividend yield does not necessarily mean that the stock is a better buy. And next, you have your price to book ratio, and this is calculated by taking the stock price and dividing it by the book value per share. Basically, this is going to tell us the market valuation of a company, which is usually higher, versus its book value. And the book value is found from net assets of a company, aka your assets minus debt. For your PB ratio, anything under 1 is considered good, and anything over 1 is considered overvalued. But in today's market, this is not very realistic, right? A price to book ratio of under 3 is going to be good in today's market, and anything over 3 is going to be considered overvalued. Continuing on, we have profit margin, and this is your profit per dollar of revenue expressed as a percentage. So basically, a 20% profit margin means that each $1 of sales results in a net income of 20 cents. Obviously, the higher, the better, and this is usually used to assess a company's financial health. Typical profit margins are going to vary by the industry sector. So for example, tech companies usually have pretty high profit margins versus physical goods companies. Those tend to have lower profit margins. Next, you have the return on equity, the ROE, and this can also be rephrased as return on net assets. The ROE measures the financial performance of the company, and more specifically, how efficiently a company generates profits. And the way that you actually calculate this is by taking the net income and dividing it by the shareholders' equity. In general, anything above 15% is going to be considered good, but this, of course, also depends on the industry sector. Next is your current ratio, and this is calculated by taking the current assets and dividing it by the current liabilities. Basically, the current ratio measures short-term liquidity of a company. It's pretty difficult to compare and standardize across different industry sectors, but I personally do like to see it above 1 because this does mean that they have more current assets than current liabilities. And the main factor for this is, like, does the company have enough cash to pay off debts in the short term? I'll say that if the current ratio is too high, then this could also mean that they aren't using their assets efficiently. So I do think that it should be a good balance, right? Anything above, let's say 4 or 5 could be too high, and anything, under 1 means that in the short term, they would not be able to pay off their current liabilities with the current assets that they have. So now I'm going to take you guys through a stock on Yahoo Finance. This is one of the platforms I use to analyze stocks. You can also do this on Webull or Moomoo, but you can see this is the current market price. $148.47. You can look at the 52-week range. So the minimum in the last year was $129.04, and the highest price in the last year is $182.94. Here's going to be the trading volume. So 77.6 million. Over here you have the market cap. So obviously Apple is a huge company. So the market cap is $2.4 trillion, meaning it's definitely large cap. The beta is 1.19, meaning it is a little bit more volatile. Here the P ratio shows it's 24.14. The earnings per share is $6.15. It's also going to give you the next earnings dates as well as the current dividend yield, which right now is 0.63%. This means that for every $100 of Apple stock that you own, every year you should expect to get about 63 cents of dividends. Here's where you normally would be able to see the valuation measures. So they don't have any of this data right now, but you can see the price to book ratios right here, as well as the 5-year expected PEG ratio. It's going to give you the profit margin, so 26.41%. We'll have the return on equity, so 149.27%. It'll give you all the information about their income, so like the revenue. It'll tell you the total cash that they have, as well as the current ratio. So theirs is 0.93. And then I also like to come down here to the analyst recommendations. So you can see right now it's rated as a 1.9, meaning it is a buy. And then you can also look at the analyst price targets. So right now the average analyst price target is $190.20, and this allows you to compare it to the current price of $148.47. So obviously the average price target is much higher, meaning that analysts do think that Apple's price could go up. But of course, these are just analysts. They aren't always right. It's just one of many different things you should be considering before deciding whether or not you want to buy a stock. So now let's talk about timing the markets and whether or not you should do it. First off, what is the definition of timing the market? And basically, timing the market means you're trying to predict the stock market gains and crashes and using those predictions to influence your buying and selling patterns. So I will say that historically, it has been better to buy after a crash than to try and time a market high. Stocks and the market as a whole tend to recover just based on history. And as of right now, depending on when you guys are watching this video, I know that a lot of stocks have corrected in the last few months. So definitely right now is a great time to buy stocks if you look at it from a long-term perspective. Another thing you should do is don't sell during small crashes. This is called panic selling, and instead you want to focus on the long term, right? Hold your stocks for as long as you can. Basically, the longer you hold your stocks, the safer investing becomes. And so I'll say the safe answer is don't time the market. Don't try and wait until you think stocks are at an all-time low. And then also don't try and sell only when you think stocks are at an all-time high. Instead, spend as much time as you can just in the market. Now, the reason why trying to time the market is so hard and why almost no one can do it is because you need to be right 2 times. So you need to guess the top of the market to sell, and you need to guess the bottom of the market to reinvest. Obviously, this is extremely hard. And I'll say that the market moves in an interesting pattern. Most gains or losses occur very, very fast. So if you're trying to time the market, it's very likely that you miss those days. And research shows that, if you miss these high gaining days, then your overall stock market returns just become extremely, extremely less. That's why you just want to spend more time in the market so that you can really guarantee your chances of hitting those big gaining days. Instead of timing the market, what you want to do is dollar cost average. So the definition of this is when you're gradually investing into a stock or stocks over time instead of all at once. This allows you to control your average price and helps protect against volatile price movements. This is a very great tool for new investors who want to limit risk exposure if a crash does occur. So basically, instead of putting all your money into the market all at once, you're splitting it into different chunks. Let's say every week, every 2 weeks, or every month. I will say that historically, since the market generally moves up, it should technically be better to buy all at once, but that is a little bit more risky because if it does crash after you put all your money in, then obviously that's not good. In volatile markets, dollar cost averaging can be a really great strategy. This is how I encourage most of you guys to invest. Just continually put money into the markets without caring about if there's a recession or if there's a bull market or whatever. By dollar cost averaging, you are essentially doing the opposite of trying to time the market. And so that's why I really recommend doing this. Now let's talk about appreciation versus dividends. So these are 2 different ways that your stocks can make you money. So with appreciation, you're making money when there is a rise in the share price due to company performance as well as market sentiment. So let's say you buy a stock at $10 and it appreciates to $12. You sell it and you see a gain of $2. So in this case, you've made $2 due to appreciation. Now, I will say that appreciation is not guaranteed. It can go either way, but in the long term for good companies, you should see appreciation. With dividends, these are usually paid out quarterly, but it does depend on the company. And the great thing about dividends is that it gives you a recurring income. With this income, you can actually reinvest it into shares of that company, or you can pull it out as sort of like being paid to own the company. These dividends are paid from company profits, and this is just another way to make money from your stocks. I'll say that one is not better than the other, right? It's sort of like an apples to orange comparison. And the fact is that a lot of stocks actually appreciate as well as pay out small dividends. The reason why some people prefer stocks that don't pay out dividends is because you don't get taxed until you sell. With dividends, this counts as income, so you have to pay taxes. Whereas Whereas if you have stocks that only appreciate and don't pay out dividends, you actually don't see any taxable event unless you sell the stock. It's interesting to know that most tech stocks actually do not have dividends and they rely solely on appreciation. If you're investing, I recommend just diversifying. Buy a mix of stocks that appreciate as well as a mix of stocks that also pay out dividends. Dividend stocks usually fare a little bit better when there is more market volatility, whereas in bull runs, stocks that appreciate a lot are obviously better. So now let's talk about the tax implications of investing. More specifically, what happens when you sell a stock. Everything here applies to these taxable standard accounts. So essentially, you are going to be taxed when you sell a stock or any capital asset for more than you paid. And this is because it results in capital gains. This is why before selling a stock, you should really consider the amount of taxes you're going to have to pay. Now, this is very important because we have two different categories. You have your long-term capital gains and you have your short-term capital gains. The reason why I really preach long-term investing is because you can take advantage of those long-term capital gains rates, which are usually going to be much lower. So if you sell a stock after at least 1 year of owning it, that's going to allow you to pay those lower long-term capital gains taxes. And that's going to be 0, 15, or 20% depending on your income level. So if you guys take a look at this little table right here, this is going to show you your long-term capital gains rates depending on your income. So if you're single and you make between $0 and $41,675 per year, you're actually going to owe 0% taxes on these long-term capital gains, which is absolutely amazing. This bumps up to 15% if you make up to $459,000 or 20% if you make more than that. Now, on the other hand, you have short-term capital gains, which apply if you sell a stock that you've owned for less than 1 year. This is going to be taxed as ordinary income, so that's going to be between 10 to 37%. And yeah, that depends on your income level as well. So in general, you guys, holding for over 1 year is going to result in way less taxes. And you might be thinking, like, how do I know how much money I've made buying and selling stocks in a given year? Well, lucky for us, your brokerage is actually going to send you a tax document each year with your capital gains or losses. Overall, I'd say that if you want to invest and you want to pay the least amount of taxes possible, hold for over 1 year. This is going to have a significant impact on your profitability with investing, especially if you are in a higher tax bracket. So now let's talk about retirement accounts and how you can save money on taxes. Like I mentioned before, I definitely recommend taking advantage of tax advantage retirement accounts. For example, the Roth IRA, which we are going to talk about right now. With the Roth IRA, you're going to be paying taxes on the money you're making now, putting that money into this investment account, letting it grow, and then when you take out the money after you retire, you pay 0 gains on the taxes. This is going to be the best when you think your marginal taxes will be higher in retirement than right now, which, let's be honest, is probably going to be the case. If you think about it, with a Roth IRA, you're only paying taxes on the money once, whereas with a taxable account, the standard account, you are paying taxes twice. First on the money that you're making, as well as when you see those capital gains. So that's why I think it's so awesome. That's why I think anyone that can actually qualify for a Roth IRA, you should definitely do it. And I mentioned before, but you can contribute up to $6,000 per year or $7,000 if you're age 50 or older. There are some income requirements, so you can't make over a certain amount of money for a Roth IRA. But if you do make over that, you can actually do a backdoor Roth. I recommend looking into that if you are a high earner. And besides the Roth IRA, there are other types of retirement accounts like the traditional IRA, as well as the 401k and SEP. Now let's talk a little bit more about tax loss harvesting. So this is what we talked about with Wealthfront. They do this automatically for you, but I think it's also important to understand what is actually happening. Overall, this is a strategy to offset capital gains. Essentially, you are selling shares at a loss to offset a capital gains tax liability. And this is usually done at the end of the year. So let's say it's December and you realize, okay, I sold a bunch of stocks, I made some good money, but there's this one stock I had that actually is down a lot. What you're gonna do is you're gonna sell that stock for a loss, and that loss is actually going to offset any gains from that year. Then you're gonna replace it with a similar asset to balance your portfolio. But before doing that, you guys need to know the wash sale rule, and this says that you cannot repurchase a stock for 30 days if you claim the loss for tax purposes. So this is super important because if you disobey it or you ignore it, then this can actually lead to some big penalties. Here's an example of tax loss harvesting just to make it a little bit easier. Let's say you bought into stock A at a cheap price and you made $100,000 of profit after 3 months and now you want to sell it. So your total gains so far are $100,000 in short-term capital gains. Let's say that your tax rate is 37%. So you're gonna pay $37,000 in taxes. And this is not even including any applicable state taxes. You also bought stock B at around the same time, making a $50,000 loss after 3 months, and now you want to sell it. So your total loss on this stock is going to be $50,000 in short-term capital loss. So we'll take our $100,000 in short-term capital gains, subtract the $50,000 in short-term capital loss, and that's going to give us a $50,000 net short-term capital gain. This is going to result in $18,500 in taxes. So you can see that if you do tax loss harvesting in this case, your tax bill is actually cut in half. The same applies for long-term capital gains, but I will say that they must match. So you can only offset long-term capital gains with long-term capital losses and short-term capital gains with short-term capital losses. So yeah, overall, this is a great way to save money on taxes if you want to sell an asset for a profit. So we've talked about so many different things, but what would Warren Buffett do? Warren Buffett is one of the most successful investors in the world, and these are the things that he looks for before deciding to invest in a company. First, he looks for a company with great leadership. He knows that leaders can make or break a company. He also looks for stocks with a margin of safety, and he looks for companies that will last for the long term. He especially cares about strong business fundamentals. He cares about any competitive advantage, aka a moat. And he also says, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. So of course, he's a long-term investor. He plays the long game, and that's just really why he has been so successful. Warren Buffett really does think that for 95% of people, an index fund that tracks something like the S&P 500 is going to be best for building long-term wealth. AKA, most people are going to make more money by just buying something like VOO, letting it sit for many, many decades versus trying to actively buy and pick different individual companies. He also says that you must buy after doing extensive research. So you must really know the company as well as the industry. So for him, he doesn't invest in any industries that he doesn't really know anything about. He's also very big on trying to find great opportunities to invest and finding undervalued companies. Overall, he's investing with facts and not emotions, which you guys will come to realize is extremely important. There are two main investing styles that we were going to talk about today: value investing versus momentum investing. So with the value investment approach, you're buying companies that have lower PE ratios. You care more about the fundamental analysis. So like I said, PE ratio, the price to book ratio, PEG ratio, etc. You care more about buying undervalued companies that can be held long term or until the company becomes overvalued. And yeah, value strategies remain pretty stable when stock prices are volatile. Now, on the other hand, you have the momentum investing approach. This is when you're only caring about the future potential of a company. So often with these types of companies, you see really sky-high PE ratios, for example, Tesla, and fundamental analysis does not matter as much, and these investments tend to be more risky and more volatile. Company debt is also seen as good, and it's seen as a potential for higher growth, and momentum strategies deliver when stock prices continue in the same direction. What you guys can do is actually combine these two strategies to sort of smooth out long-term performance and manage your risk. With the value investment approach, you have more stable prices, you have more continual growth over the long term, but it is possible that the growth is not as much as when you use a momentum investment approach. However, don't think one or the other is better. I recommend using a balance of both of these strategies. And you guys, I want to re-emphasize the importance of investing early. The earlier you invest, the more compound interest and exponential growth you will see. Here on the left, you can see exponential growth if you invest in the markets versus a more linear growth if you invest in something just like a savings account or just holding cash. If you look at the long term, you'll be so much more rich if you invest in stocks and let your stocks grow with exponential growth. It's just not even close. So if you guys do want to, retire wealthy, or you want your money to work for you, then that's when you really want to invest in assets like stocks. So the fact that you have money can actually make you more money. This is why the rich become richer, and they have such a big advantage when it comes to building wealth. Now, in terms of how much you should invest, these are my opinions. I'll say that you should never invest more than you can afford to lose. Focus on raising your income first, right? So the more money you make, the more you can actually invest. This sounds very obvious, but a lot of people won't focus on the income generation, but actually that is probably the most important thing. The more money you make, the more money you're going to have left over after paying your expenses, and all that money can be put into investments. Let's say you have someone making $50,000 versus someone making $200,000. Let's say both of their expenses are $30,000 per year. For the first person, they only have $20,000 extra to invest, whereas the second person, they have $170,000 to invest. So huge difference, and that's why it's so important to focus on raising your income. If you're young and you have excess cash, definitely consider opening up an account after watching this video, because of course, course, knowledge without action is pretty useless. Yeah, so overall, invest early to start taking advantage of compound interest, and also consider investing in things with a higher ROI. So there's so many different things you can invest in that isn't just stocks. For example, building a business, self-improvement, education, courses, or networking. A lot of these might have a higher ROI than stocks, so I recommend doing a bunch of these different things. Don't put all your money into stocks. Set a monthly goal of how much money you want to invest based on your income. And like I've said throughout the video, prioritize index funds. Index funds make investing so easy, and that allows you to focus more of your time and energy on building your income versus getting stressed out about, which companies to invest in, as well as trying to time when you buy and sell stuff. That's just why I'm such a big fan of buy it, set it, and forget it. And of course, if you want to save more money, consider starting to budget, because the more you budget, the less money you'll spend and the more money you'll have to invest in assets like stocks. Something I need to emphasize again is due diligence, right? So do your own research before investing in anything, especially something like stocks. My golden rule is you want to spend 1 hour of research minimum for anything you're looking to invest in. And if you don't want to spend any time, doing any research, just use something like Wealthfront, because they're going to do all that work for you. Find out what kind of investor you are. Look at your risk tolerance, look at your timeline, and look at how much time you want to, devote to researching different companies. The first level of due diligence comes from the brokerage you use. So don't use any phony companies, use something like Webull, Moomoo, or Wealthfront. And the second level of due diligence comes from your own research as the retail investor. So that's looking at the fundamentals and technical aspects of these companies. I know this video was super long. We covered a lot of stuff, but there is still a lot of other things you can learn about investing. So if you want to do more research, here are 3 books that I definitely recommend checking out. The Intelligent Investor by Benjamin Graham is a classic. Almost every investor reads this book. You also have the Investing Quick Start Guide, which is a very actionable guide to investing. And you have the book Warren Buffett and the Interpretation of Financial Statements. This book will change your perspective on what you should be really looking for in any value asset. And to end the video, I want to again say all this knowledge doesn't mean anything without any action. And so these are the actionable steps you should be taking right now. First, open up a stock brokerage account and get free stocks using those links down below. Next, fund your account, do any due diligence for any companies you want to invest in, and then buy your first stock. After that, continue learning about the stock market so that you can become a better investor. And if you don't want to do any research, just use something like Wealthfront. Get your $20 when you sign up. They're going to ask you a few questions to determine your risk score, and they're going to do all the hard work for you. So you'll need to spend 0 hours on research. So that was a lot of talking. I feel like I can barely talk anymore, but I really hope you guys got a ton of value out of this video. I really enjoy making videos like this because I'm just such a big believer on the importance of investing your money. Investing in things like stocks allows your money to make money for you, which detaches time from money, which is essential if you want to build true wealth. So I really appreciate all the time you guys have spent with me. I truly hope that this video helped you guys out. And of course, we went over so much stuff, so feel free to reference this video at any point. If you have friends that are interested in investing, feel free to send them this video. And if you guys enjoyed it, feel free to hit that like button and also subscribe for more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. Again, thank you so much for your time, and I'll see you in the next video. Peace.